Chase Coleman's hedge fund, Tiger Global, is delaying investments in startups for 2 quarters. The firm, which manages over $20 billion, said it's pausing startup ventures due to recent market volatility, which has caused its fund to drop 52% this year. Tiger Global, not the only hedge fund pressing the pause button. Look at this. According to PitchBook, investments in tech startups have plunged 23% over the last 3 months alone to $62 billion. That is the steepest decline since 2019, right before the pandemic. And here in a Fox Business exclusive is the EquityZen co-founder and chief strategy officer, Phil Haslett. Phil, what is the strategy right now?
Well, with this lack of IPO activity that we're seeing and also a cool down in venture capital activity, we at EquityZen have seen a lot more interest from, shareholders of these private companies that really need some liquidity, for things like down payment on a house or paying down student debt or just dealing with rising costs.
What exactly does EquityZen do?
So we are an online pre-IPO marketplace. And what that means is that we connect investors that want to invest in private technology companies before they go public. And we connect them with shareholders that are typically employees or ex-employees that might want a little bit of cash to diversify or pay down some of the costs that they have on their end. We've worked with about 350 companies like Spotify and DocuSign before they were public.
Okay, and that's why you had mentioned that they might need the money to buy a house or pay down debt on the employee side. We mentioned Tiger Global coming into you, that they're delaying their startup investments till December. Is this only market volatility, or is there something else going on?
There was a lot of what we'll call irrational exuberance, mainly in 2021, where a lot of investors poured a lot of dollars into private technology companies while interest rates were really low. And there was a hunt for returns amongst all different types of investors, including Tiger Global. And what that led to was a lot of competition and increased pricing and valuations for companies that's really coming crashing down to reality. And so I think what we're seeing is kind of a reset from some investors like Tiger Global and others, particularly when those types of investors can invest in either the private markets or the public markets, and maybe they're seeing some better opportunities in the public ones for now.
Because things are cheaper or more safe in the public markets?
Yeah, things are a little bit cheaper, they might say, or they have a bit more visibility into the companies themselves. You get a little bit more disclosure in the public companies, but what we'll expect to see is that as public companies, particularly in tech, kind of maybe bottom out and start to show that revenue is increasing again, or that earnings are increasing, we expect to kind of see that sentiment flow down into the private markets, which are usually a lagging indicator. And we'll start to see more investments come back from venture capital firms and places like Tiger Global.
And it sounds to me that the private markets, or these smaller companies, these unicorns, they're completely more risky right now, right? And that's the last thing investors want to touch?
Yeah, they are inherently more risky. They are a little bit earlier stage than, more bona fide blue chip names like IBM or what have you. However, they also offer an opportunity for investors to kind of get in earlier stage. The example that we give is that, when Amazon went public in 1997, the company was worth about $400 or $500 million. Compare that to Uber, which went public at, north of $50 billion in valuation. If you were just a public market investor, you really didn't have any access to Uber. So a lot of times we see investors look into the private markets because they have a chance to kind of get in on the ground floor, if you will. But that always comes with risk.
You said earlier that it's back to reality for a lot of these companies. Is it really back to reality, or are we in a completely different reality? Because all the activity that we saw last year with low interest rates and a lot of enthusiasm, that's, come to a ground halt.
Yeah, absolutely. I think it is a dose of reality, and you're going to have some companies that are going to struggle and, quite frankly, go out of business or have to conduct layoffs, which we're already starting to see happen. However, I think there is another cohort of businesses that raised some of that money last year that are going to spend that cash prudently and may have a slightly lower valuation than they had a year ago, but were at terms with that when they took the money before. But again, 2021 was a completely kind of unique year we saw within the kind of venture capital raising space. Some people try to compare it to, kind of the years leading up to the dot-com crash. I think you've got a little bit more meat behind the businesses this time around. We're not valuing companies based on eyeballs or users, but actually on fundamental revenue. But it is going to take a bit of time before we kind of start to see prices lift back up.
Do profits matter again?
I sure hope so. In my opinion, they should have always mattered, but there's definitely much more of a lens on them now. Venture capital firms are telling their companies that, cash is king and profitability is king, which is a big 180 from growth at all costs, which is what we heard of 12 months ago. But we've seen this song and dance before. Probably, EquityZen's been doing this for about 9 or 10 years. We've actually seen this kind of back and forth 3 or 4 times, even in the last decade. So it doesn't come as too much of a surprise.
Phil Haslett, thanks for the time. We appreciate it.
Thanks.